Hey, good morning, everyone. Marty Missouri here. Wednesday, January 22nd, 2025, with your midweek commentary. As I've illustrated the last month or so, our economic assessment, based on the 43 data points that we track week in and week out, has actually improved to essentially neutral, where for a long time now, odds really pointed toward recession risk being greater than continued expansion risk. And right now, it's essentially dead neutral, meaning the odds are equal in either direction. So that is not a reason to celebrate, for sure, but it also is cause to rethink the allocation to our core in terms of sectors, regions, that sort of thing. What I illustrated a lot at the end of the year, toward the end of the year, certainly in the year-end message, is that non-U.S. equities are historically attractive on a relative basis to U.S. equities. And we're seeing that expressed of late, probably mostly in the Eurozone, and I'm also seeing some sentiment pick up there in the Eurozone. By no means is the area in the aggregate out of the woods, certainly not the German economy, but there are pockets of strength and optimism. And even for the German economy, the latest sentiment surveys show increased optimism. And this is in the face of real credible threats of increasing in tariffs from the U.S. So with regard to that, and that's really where a lot of the back and forth and the volatility, I think, is going to come from. Just the other day, the inauguration, the lack of commitment to throwing on new tariffs was very welcomed by global equity markets and fixed income markets and currency markets. So pretty much across the board, it was very welcome. Before the day was over, in an interview, the president said, we're going to throw tariffs of 25% on Mexico and Canada, highly likely as of February 1st. At that moment in the futures market, the Dow, for example, went from like 270 points up to almost 200 points down. So almost a 500-point swing, and that was across all markets, all indexes, and so forth, is certainly in the equity space. But people thought through it and thought, well, the general theme is it's not going to be as immediate or as large as what may have been hinted on the campaign trail, and as was reflected in December's global equity market reaction. Remember, December was a bloodbath. U.S. stocks overall went down over 7% in the month of December. Probably other factors, but that was out of a lot of fear of what was being promised. And folks, just remember, too, that as I illustrated on two separate videos, the whole experience during the first Trump administration was kind of a moonshot all the way through 2017. And then about 20 months where the market stayed in the same place, or finished 20 months later from January 2018 to where it started. So go from January 18 to late summer, fall of 19. And the market was in the same place, except there were combined about 30% of downward corrections that were experienced during that time, 10 and 20% respectively. And the key narrative that whole time was the trade war. So it would make sense that the market is fearing, a redo of that on top of the increased protectionism that was experienced during the whole Biden administration. So he actually added to it. And then to throw more on top of that, realistically has the market somewhat nervous. Now, it's been a pretty good run so far in January. And as I illustrated last weekend, the breadth has been very, very good. And that's very encouraging. What I mean by breadth is it hasn't just been all about technology stocks like it was the last year or two, which is a dangerous market to tread in. But broad-based, we added to small caps. We added them and then added to them. That's been a good thing to own here very recently. We added to industrials exposure, materials. We took down our consumer staples exposure a bit to respond to the improving signals that we're getting in our own economic analysis. However, again, let me reiterate, we are in no way coming off of, a late cycle clearing of markets where you really can get robustly, if you will, or across the board bullish because you're coming from cheap valuations, looking at a new expansion. We are more than a little bit optimistic about the next cycle and how it's going to play out and what it's going to mean in currency markets and therefore for the way we manage money. But we're not there yet. You just have to be cognizant of that. Let me just jump to some slides or charts for you here, and then I may add just a little more context in the overall setup at the end. So I just talked about, in an optimistic sense, about breadth and how good it has been. Now, unfortunately, and one day does not a trend make, mind you, you can flush that idea today. Okay, so if you just look at the headlines, you would see an S&P 500 that's up very nicely, like 0.75%, a NASDAQ 100 index that's up 1.53%, and a Dow that right now is up 118 points. The Dow is just up 0.25% or so. But then we look at the breadth, and speaking of the Dow, 18 of the 30 Dow stocks are in the red, actually. 12 of the S&P 500 stocks are in the red. And NASDAQ Composite, 1,700 down stocks down compared to, call it 1,200 stocks up. This is the bad breadth that is not a hallmark of a good, healthy market. When I look across, just using our core portfolio as an example, it is the epitome of a broad-based, well-diversified global portfolio, not just in equities, but commodities and so forth. We're up a little bit this morning, call it flat to slightly up. But as I look across sectors, healthcare is flat. Materials are down 0.3%. Industrials are slightly down 0.05%. Financials are down, notably, down 0.2%. Consumer staples are down slightly, 0.14%. Tech is up 2%. That's good. That's certainly helping. Small caps are down 0.2%, just looking at that space. Energy stocks are down 0.5%. Utility stocks are down 1.5%. Mining stocks are down 0.5%. Let's see. Communication stocks are up 1.5%. So tech and then communication, which is essentially the same thing or closely related, are having a ball this morning. And then I'm getting to smaller positions that we have that can add some oomph if they're up enough. Palladium is up 3.3%. Applied Materials, which is a new stock that we purchased recently, is up 3.7%, and so on. And we have added to the core a biotech company, Delcath. So clearly what we're doing, clients, is we are actively looking for value in a very pricey market that has a lot of risk still dialed into it. If you didn't read my year-end messages, please do. You're going to see valuation levels that are only seen at times when they don't resolve happily. And so, not that this time won't be different, it's just that we have to be very cognizant of that as we move forward. Okay, so there's that. I'll just go to the technicals. I wanted to keep this pretty brief. So again, we just did this over the weekend. Remember, I said it was bullish, that the market had broken back through the 50-day moving average. If it can catch some momentum, maybe a retest, we're going to be at all-time highs. We're virtually there right now as I speak. And there's nothing bearish yet about at least the daily chart of the S&P 500. So this very well could go for a few more days. No guarantees, a lot can happen. A lot of commentary can change that in a hurry. The NASDAQ 100 index, or the ETF that we track, you can see again, we did break above that 20-day moving average. It's starting to slope back up again. That's positive. We do have a gap here that may get filled, of course. A nascent buy signal on the MACD. So again, just looking at the daily charts in the interest of time. These are not scary charts, at least in the near term. When we go further out, look at the longer term charts, you can see the risk that I'm talking about. I've been featuring the dollar of late. I said if it rolls over, which is exactly what we said would probably happen right here based on our technical analysis, that would be bullish for stocks, and indeed it has been. More so that if yields were to roll over, that would be very bullish for stocks. And that's exactly what happened. Remember, we made that call right up there, and that's what's happened. And they're backing up a little bit here right now. We'll see. That would be a headwind for stocks, obviously, if they took off. And again, I have to even remind myself, stocks are down today. Essentially, 2/3 of all stocks in the U.S. are down today. So this is right now looking like a headwind for stocks. But you wouldn't know that if you just look at the headline averages. And then we've been featuring gold, which is an important position for us. Like the action because we own it. Gold is about to get back. This is GLD. It tracks the gold price. It's about to get back to its all-time high. You could see a big breakout above that. We are very bullish gold long-term. I'm not crazy bullish in the short run. I can see a lot that can go wrong from these levels. So we have a hedge on that takes us right now through March that'll protect us from anything too consequential to the downside. So there's just a brief update on the technicals. Not bad for equities. Some supportive indicators that we track, like the dollar and yields, and there's lots of other things, but those are supportive still probably of equities right here in the near term. Okay, so just in closing, I'm just going to look over at my notes. Some of this is more food for thought than anything else. This is just this morning. Ally Financial in their earnings report confirmed that they will stop all mortgage originations. They're also, by the way, selling their credit card business. This is interesting, no doubt. What does it say? I guess we can debate that, but on balance, not something good, obviously, but about at least their business model and where they think the opportunities are. It's a sign of broad retrenchment across the mortgage industry, origination capacity, after years of weak activity. Question: how will originators handle a rapid uptick in volume should rates drop? It's plausible that reduced capacity will mean that when current high-rate borrowers go to refinance, or homeowners with a low rate feel comfortable moving to a different home with a new mortgage rate, the capacity to underwrite loans won't exist. Rate declines will be absorbed as profit margin for originators, rather than material decline in rates paid by borrowers. I don't know. I just thought that was interesting enough and thought-provoking enough to share with you. I don't know that we're going to have all that reduced capacity, or that capacity won't expand quickly enough to absorb demand if and when rates drop, which would take a slowing of the economy and, of course, a slowing of inflation. And then mixed global signals. Maybe I'll stop with this one. South Korean exports are very important to keep an eye on relative to global economic activity. And they reported a decline in preliminary exports. It reverses an upward spike in December, and exports have not hit a new high since August. Exports to China fell 4.9%. Exports to the U.S. fell 9.6%, the largest on a year-over-year basis since the COVID shocks. That's interesting with regard to the current state, or maybe the go-forward trend of the global economy and of the U.S. economy here. And I highlighted these in yellow to emphasize how I feel about it. Auto industry sales in the Eurozone remains anemic, and with little changes in sales volume over the past 2 years. I mentioned German sentiment. I highlighted that in green because it's actually beginning to pick up in the ZOO business survey, and emphasizing relative to that of the overall Eurozone. The last 2 months have been more positive. The sentiment towards German economy remains extremely weak, so take that for what it's worth. On a relative basis, starting to improve, so that qualifies a little better what I said earlier about Germany. And then for the United Kingdom, wages were stronger than expected. The three-month average year-over-year readings picking up sequentially, despite an ongoing decline in payroll employment as shown below, which creates a real puzzle. So we'll see how these things shake out. And then lastly, Bank of Canada released its quarterly look at business sentiment. Future sales growth expectations rose to the highest levels since the rebound from the COVID shock. Expectations for both higher prices paid and received going forward, while investment intentions also rose. I think this speaks to the ultimate belief that the Trump administration is going to come to workable, mutually beneficial terms with our trading partners. Now, there's an active debate. Are tariffs part of Trump's DNA? Does he really mean it? Is he really going to do it? Is he really going to cause that kind of pain on the global economy? Or are they just negotiation tactics to get to a better place overall for the U.S. in its trade relationships? Now, I actually am leaning toward the latter, despite how tariff has been so much of the Trump narrative for years and years. And whether that's true or not, know that in the art of negotiation, if you have a stick to use, it can't be presented as simply a stick for negotiation purposes. It has to be believed, and it has to be presented as if we really want to do this to you. Or the other side is going to think, it's just negotiation tactics, it's bad for both, and they'll never do it. The market is definitely, save for today's bad breath, siding with the notion that everything will be great, there'll be these deals, things are going to be good, and we're going to do really well as a result of these negotiations. And I think that's actually a legitimate assumption. Thing is, when we're talking about the equity markets, we must not forget the lesson of 2022. At these valuation levels, at these interest rates, anything resoundingly good for the economy probably is not going to be resoundingly good for the U.S. market. And the reason I say that is because we have a lot of accumulated inflation and a structurally higher inflation setup than we've had for the last 50 years. And I've been writing about that for the last 2 or 3 years. So you add fuel to that fire and you start stimulating the economy, well, then you're probably going to stimulate these inflationary forces. And remember, in 2022, stocks went down about 30% peak to trough. And that was not due to recessionary fears, which is the ultimate fear we should have, but it was due to inflationary dynamics. And so clients, I just want you to understand and appreciate kind of where we're coming from in that 100% at the margin, we are allocating to areas that make sense given where we see policy going, where we see investment going, and where we see, obviously, opportunities that present some value. In the aggregate, this is still a dangerous spot that we're standing in. So we need to be smart, thoughtful, and hedge and all these things that we keep talking about. Went a little longer than I expected to. Sorry about that. Hope it was useful for you. Have a great rest of the week, and I'll talk to you over the weekend. Take care. Bye-bye.